So welcome to our second town hall with the good folks over at Dimensional Fund Advisors. If you recall, we did Apollo last time, and just yesterday we received the final approval for our edited version of that. It was an hour and a half. We narrowed it down to an hour. And so we'll be posting it on IFA.com shortly. Today's session, though, is with the one and only Weston Wellington. First of all, incredible name there, Weston. But second of all, Weston is a literal cornucopia of knowledge of historical markets, information on the markets. I think one of his favorite hobbies is tearing through old business magazines and pulling predictions and quotes out, sticking them in his safe, and then waiting 5 or 10 years and
That's
going
right.
back and pulling them out and say, well, I wonder how that worked out.
Called the wine cellar approach to investment research.
There you go. So Weston has been doing this 40 years, almost double. I'm 21 years, double my time of doing this. So he has certainly seen far more than I have, let alone the fact that he has traveled the world speaking to advisors and their clients. And it's one of the reasons I wanted to get Weston on our town hall this morning. He will be answering a number of questions that we had submitted today, and some that we've sort of pre-made up for you. And we're going to go through a whole bunch of those, and Weston's got some pre-prepared slides that we're going to use as well. I want to thank Christopher and Kenny for helping set this up, and for the Dimensional team through their events group who helped organize all this, and does a very good job at this. So Weston, first of all, thank you for being here and for joining us from your farm. Well, we have a number of questions to get to today. And so let's go ahead and get started. One of the first ones came in from somebody who signed up for our program today. And by the way, we're up to 135 now. And they said there are a lot of key economic indicators which points to not just a recession, but maybe even a depression. Can you discuss what might happen if we do go into recession? And as this person said, if we might even reach a 25% unemployment rate. But I think if you just kind of cover the recession discussion, that'd be a good place to start.
All right, always a popular topic. And I think a sensible question that we need to address is, why would we want to hold stocks during a recession? What happens in recessions? Business activity tends to slow down, profits drop, some companies come under financial distress. A certain number are going to be going bankrupt in any point in the cycle, but typically a lot more of them go bankrupt during a recession. So why would we just wait until the storm is over and then get back into the markets and go about our job of investing? Well, that sounds appealing at some level, but the problem is we don't really know when recessions are starting or stopping. And more to the point, all the investors are reading the very same economic indicators. They're all trying to figure out when the next recession might start. And if it does start, when it might stop. And they're competing with each other to try to get the best opportunities and figure out the best time to be investing in stocks. Now, here's an example of the problem. Now, this doesn't happen in every single cycle, but it happens often enough that it gives you an illustration of what our challenge might be. So the Scorekeepers for Recession is an organization called the National Bureau of Economic Research. And they have something called Business Cycle Dating Committee, which is not like a social frat house kind of thing. It's a group of economists who get together and decide, when did the recession start and when did it stop? So the recession in the early 90s lasted from, according to them, from July 1990 to March of 1990. And they later figured out, after it started, that it ended in 91. And I've got a chart of the S&P 500 here. Now, first of all, notice that by the time, let me just advance one more here, they announced the beginning of the recession in April of 1991. So it takes time for the economists to figure out, by looking back at the data, okay, that was a peak, and now now the valley of the recession is in existence. So we don't really know how long that valley might last. Okay. Now you notice how the green arrow is when it ends. They didn't announce it was over until December 1992. So notice here, by the time the officials had announced we were in a recession, it was already over. But we just didn't know it at that time. And notice what's been happening to stock prices. Stock prices went down well before the recession was officially announced. And they began to go up, not only long before the end was announced, it went up before the end of the recession. And this is the key thing that bamboozles or frustrates many investors. Stock prices tend to be the leading indicator that helps holds the future for the economy, not the other way around. So the fact that the market has gone down dramatically, that's a pretty powerful indicator that we'll have a recession, probably a very severe recession. I doubt anybody listening here would quibble with that statement. Now the question is, how far away is the recovery? No one knows for sure. And markets are performing a function. They're trying to aggregate all the opinions of all investors who are carefully studying every scrap of information they can to try to assess, when is the recovery likely to start? And if it does, how powerful is it likely to be? What are the implications going to be for companies, employees, corporate profits, dividend payments, and so on? This is a very uncertain process. We don't know what the future looks like. And that's why stock prices are so volatile, even in normal times, and even much more so in highly uncertain times like we have today. So all we can say for sure is that based on past evidence, it's much more likely that stock prices are a better leading indicator about what the economy will do, rather than the economy be a leading indicator for what stock prices will do. And so the conclusion for the investors, I believe, is that you're competing with so many other people trying to assess and analyze the same data. It's unlikely you are going to be the only one to figure out just the right time to invest in stocks based on your assessment of economic data.
All right. So I am getting a comment that the audio is not particularly optimal. I just want to let everybody know, thanks you, Ron, for your question, that we did try Wes's cell phone and we didn't get much better results there. So we're just going to go with this and you know, it's the internet. Unfortunately, that's what we have to deal with. But I think if you listen carefully, you'll get the main points that Weston is trying to make. So Weston, I've got another question, and it has to do with that small cap premium. And as you know, Fama and French have done tons of research on the differences between large companies and small companies, both in their risks and their historical returns. And by one measurement, when we look at 92 years worth of data, that small cap premium has been 2%, but there's a 11% standard deviation around that thing, lots of variation around that excess return. Do you think that small cap premium has disappeared, Weston? And could you maybe address that point?
I want to address that point, but in kind of a roundabout fashion.
Okay.
There, from time to time, concerns, questions about both the small cap premium and the value premium. We don't tend to hear too many questions about the equity premium, meaning the extra return investors get for investing in stocks rather than risk-free treasury bills or bank CDs. But let's remind ourselves, there have been times in the past when the equity premium looks like it had vanished as well. This is the famous or perhaps infamous cover story, The Death of Equities. When this cover story appeared, stocks had underperformed treasury bills for roughly 15 years. People tend to be grumbling because the small cap premium has been extending for perhaps a decade, but 15 years. Suppose your financial advisor had counseled you at this time, yes, this hasn't been a pleasant experience. We didn't expect it, but I still think stocks are a good place to be. And you might say, this article makes a lot of sense to me. It talks about how high inflation and high interest rates, like we've never seen before, have permanently changed the outlook for investors. And stocks no longer make sense as a buy and hold strategy. They only might be useful if you can trade in and out at just the right time. Maybe your advisor is very persuasive and convinces you that to stick with it. You grudgingly leave the office vowing, I'll be watching you. You come back 3 years later, almost exactly 3 years later. And where's the Dow Jones average? It's about 100 points lower. Now you have 18 years of underperformance in equities. Boy, it sure looks like Business Week made a terrific, correct prediction. Why would anybody invest in stocks if I can do worse than treasury bills, which essentially have no risk, for 18 years? Well, as it turned out, this day, August 12th, was the last day of that long, frustrating down cycle for stocks. And the next day was the first day of a hopefully still unfolding bull market cycle. Who was along for the journey and who jumped off the train? So with that background, let's talk about the small company premium. Has that disappeared? Once again, this is not the first time we've heard questions about the small cap premium. Many of you may recall that in the late 1990s, big company technology stock in particular had a fabulous run. Even big sort of old line companies like General Electric did extremely well. What was happening with small cap stocks? It seemed like they were off for a long walk in the desert and they were just about to die of thirst. This individual pictured here was the small cap strategist for a very prominent brokerage firm, which suggests to me that her principal job was to figure out, is this a good time to hold small cap stocks or not? In this New York Times article, she essentially said, I don't see any reason why small cap stocks can go up. And I'm running out of ideas. It turned out this article was published in late March of 1999. It was almost the precise bottom of small cap performance relative to large cap performance. And she certainly wasn't the only one with this opinion. I have half a dozen articles from this period essentially saying a repeat of what we're hearing today. Small companies just can't compete with large companies. There's something that's fundamentally changed the economy that favors large companies versus small companies. Let's keep in mind what the economists have an irritating habit of reminding us. All stocks, by definition, are owned by all investors. There are no orphan stock certificates blowing around the streets of major cities at night. At the end of every day, every share of every company must be owned by somebody. Well, how's that going to work? Who's going to wind up owning shares of these permanently wounded small cap companies? Somebody has to. This is where the price system comes in. Markets have to price stocks of even the most unappealing companies low enough relative to the more appealing companies to ensure somebody winds up owning these shares when they could just as easily have bought shares of some large, fast-growing company that same day. There's a lot of variation in all of these returns with large companies versus small companies, with value companies versus growth companies, or as I've shown you, with stocks in general versus risk-free treasury bonds. Before we bemoan this state of events, let's ask ourselves, shouldn't we be careful what we wish for? If small cap stocks or value stocks or stocks in general always had higher returns, it wouldn't really be riskier. And whatever premium was associated with those types of investment would essentially shrink to close to zero. So the fact that there is a great deal of volatility, a great deal of uncertainty, and there's always the risk that none of these premiums in fact pay off, even over very long periods. That's the source of that higher expected return. So our job as investors is to understand and acknowledge, even embrace the uncertainty associated with all of these premiums and construct a portfolio that we can live with, even when these premiums may appear to vanish for long periods of time.
So along that line, Weston, is the question, when we're designing portfolios, do we really want to diversify into these international and emerging markets? You know, you got China and Indonesia and Brazil and all these countries that, you know, seem like they're kind of in trouble, and the US seems so safe and such a good bet. Do we really want to invest internationally?
So why would we want to invest anywhere except the US? So over the last 47 years, the US hasn't finished right in the middle, but pretty close. Some companies have done worse. Some companies have done better. One that always kind of surprises me is France. I mean, the returns on France versus the US they're not identical, but they're pretty darn close. But it seems every time I open the newspaper, there's an article about France, it's because they're on strike. And I think it's easy for people like me reading a newspaper to fall into the trap of, nobody wants to work in France anyhow. Why would I want to invest there? Well, let's turn the clock back. Now, let's suppose I'm doing this presentation in Tokyo, Japan, not the US. And I'm, along with Mr. Hebner here, we're preaching the virtues of broad international diversification. Now, the audience is all Japanese. They've spent their entire careers in Japan. And many of them have, not surprisingly, a fondness for Japanese stocks. And with apparent very Japan has been the best performing stock market around the world for 8 years. All the data on economic growth and other assorted indicators to confirm that notion. Books and books and books written about the astonishing success of Japan, the wonderful educational system they had. You could leave your luggage on a subway car and no one would steal it. They invested for the long term, we were told, not like trigger-happy Americans investing for quarterly capitalism. A number of these books suggested this was a near permanent state of affairs. Now imagine I'm trying to explain or urge Japanese investors to diversify around the world. Do you have any data to show us? They would say. Well, actually all the data I have shows you that Japan has been the best stock market to be in. So why would I want to change? You wouldn't, unless you could figure out some reason why there might not be a future for Japan the way it's been in the past. Didn't seem to be very many reasons. This is chairman of Sony, Akio Morita. This appeared in the late 1989 at almost, not quite, within a few months, the all-time high of the Japanese stock market, which has climbed back to equal that level. And the gist of this article was, if you think Japan has been successful so far, selling us copiers and shiny new Toyotas and the like, just wait. They're just getting started. They've got industry after industry lined up in the crosshairs: construction, computers, services, banking, and they're going to blow us away one by one. They quoted one professor that kind of groping for an explanation why Japan had been so successful. It's like a culture we've never seen before on the face of the earth. They seem to be giants of some sort. What's been the investment experience for Japanese investors all in Japanese stocks, or any investors all in Japanese stocks, since that? Not very rewarding. Has Japan collapsed into a black hole of riot and depression? No. Still seems to be a prosperous nation. Looking back, it's not easy to understand why the Japanese stock market has done so poorly. I don't have a good explanation for it. All I can say is, if I were making this argument in Japan in 1989, there just could be some state of the world where Japanese stocks are no longer the best performing stock market in the world. I don't know what could happen to the US that might change our pattern of impressive returns. I do know we've seen it happen time and again to other countries for reasons that are often difficult to come up with. But to my mind, diversifying around the world in other countries makes sense. It makes sense for an American investor. It makes sense for a Japanese investor. It makes sense for a Norwegian investor. It makes sense for any investor.
Thank you, Weston. So one of the other issues that's coming up today is we are taking on more and more debt to help out with people and companies affected by the COVID. What's going to happen with this debt problem, and how might that impact our investments?
All right, full disclosure right up front here. I am not an economist. I am not trained to discuss federal funds flows or money supply figures or any of the things that we probably should be discussing to have an intelligent conclusion if we could come up with one. But I listen to people who do have those qualifications, and I don't find a lot of agreement about what the scope of the problem is or what we should do about it. But I do know, as long as I have been in the investment business, starting in 1975, I have heard wails of anguish from investors and various observers concerned about the effects of excessive debt, excessive government debt, excessive corporate debt, excessive debt among consumers, or all of the above. Well, famous time cover story. We've never seen so many indebted nations as we have today. That was 1983. This book came out in 1992. I got quite a few calls from anxious investors. This was written by a U.S. senator and a allegedly PhD that the U.S. ceased to exist by 1995. Will collapse into a cycle of hyperinflation. As recently as 2011, the debt crisis is even worse than you think it is. This is a small fraction of the outpouring of concern over our level of debt or government spending, however you want to frame it. I don't know what the proper level of debt is. And when I listen to economists on all parts of the political spectrum, what I find that they don't seem to have any broad agreement either, which tells me this is a knotty problem that none of us are likely to solve quickly and easily. Where does this leave us as investors? It always comes down to, what do I do with my capital today? Suppose I accept all these worrisome arguments that we do in fact have way too much debt. What should I do about it? Should I avoid stocks? That might be one conclusion. What should I do with the money? Should I put it into government bonds or treasury bills as a safe haven? You could, but today and in many countries around the world, your interest rate is either close to zero or some cases even below zero. So if we are in fact going to have runaway inflation, it doesn't appear that there is going to be much of a reward, much protection by investing in super safe government bonds. When we're investing in companies, we're investing in real assets. If we're investing in Disney, we're buying a little piece of that roller coaster in Shanghai. And if there is higher inflation in the years to come, for whatever reason, Disney has the flexibility to raise prices for the roller coaster or the movies or the TV shows. And to me, that's the fundamental appeal of owning real assets, whether it's land or apartment buildings or farms or factories or shares of enterprises that also own those assets. I get cash flow today, and if there is an inflationary environment in the future, I get more cash flow in the future. And there's a lot of volatility, obviously, associated with those alternative types of investments. But that's one of the risks we face when building a portfolio of assets that have the promise of higher expected returns. So I don't have any brilliant notion about what the solution to the debt crisis might be. I don't expect to live long enough to see a resolution. And I expect most people listening to this won't live long enough either, if there ever will be one. It all comes down to, what are my choices, even in what I think to be the most worrisome possible scenario?
Another common question in times like this is, wouldn't I be better off in gold? Something solid, something I can hold and something I can rely on, or even gold mining companies, for example. Oh, look, you have a slide with that very question.
Gold has fascinated mankind for centuries. I don't want to dismiss the appeal of gold right out of hand. I mean, we buried people in pyramids with gold objects. Clearly, people attach a deal of value with it. But let's look at some recent history. We don't have a long run data of gold priced in US dollars that would be useful, partly because governments over time, including the US government, have changed the legality of owning gold. Let's go back to 1973, for example, and it seemed like we were in a similar worrisome scenario of rising inflation, rising commodity prices. Maybe we should be owning gold. Years went by, gold had up downs, and it was starting to bubble up again. This is back in 2011. And it got as high as about $1,800 an ounce or so. Now, I'm shamelessly plagiarizing the chairman's letter from Warren Buffett. Many of you know Mr. Buffett is the chairman of Berkshire Hathaway, a very, very successful business that he essentially founded. He acquired control of a floundering little style company in New England in 1965 or so, and turned it into this global colossus. And I read all of his annual reports, and for years, he never made a single comment about gold. And then in 2011, he spent several pages discussing his thoughts on gold. So I thought I'd share them with you because I thought they were helpful. He said, let's all the gold in the world, all the jewelry, all the bullion, melt it down, we'll have one giant cube of gold. How big would it be? About 68 feet square side. And at that price, what would it be worth? Well, a little less than $10 trillion. So there you are. You get your block of gold for $10 trillion. What else could you buy at that time? Mr. Buffett suggested. Well, you could have bought 16 companies that were the same size as ExxonMobil. You could have bought all of the cropland in America. You would still have another $1 trillion of what he called walking around money. So over the next 100 years, he poses this question: what kind of cash flow are you going to get from gold? Zero. Doesn't pay a dividend. And if anything, cash flow is negative because you're going to have armed guards or a huge safe deposit box to store your gold so no one can steal it. What kind of cash flow are you going to get from the other portfolio? You're going to get all the cash from every crop in America, every soybean field, every cotton field, every wheat field. You're going to get all the cash flow from 16 companies the size of ExxonMobil. It's a river of cash flow that you could then invest in more assets. Trillions of dollars. Now, gold might increase in price. The only reason it will increase in price is if you can find someone else who is even more frightened of the future than you are. Looking off to the next 100 years, which do you think would be the more rewarding investment? The river of cash flow from all the cropland, huge companies, or a pile of shiny metal that pays no dividend and never will? Ladies and gentlemen, I rest my case.
Another question about strong economic growth. So that may be a ways down the road, but when it does occur, do you think that assures that we're going to get a strong stock market to go along with it?
Now, Professor Jay Ritter actually studied this specific issue. He went back, I believe, over the last 100 years and posed this question. Could we find a way, is there a link, a demonstrated link between economic growth rates and stock market returns? Does strong economic growth go hand in hand with above average returns? He says the answer is no. Now, why would that be? Well, I'll take a stab at an answer. It's not clear where the benefits of economic growth go. Here's an example. Maybe this works, maybe it doesn't. Let's go back to the 1930s, mid-1930s. It's a pretty weak economic period, but there are some new industries that are thriving. Movies, for example. Movie attendance is sharply rising. Even in the Depression, people wanted to get out of the house and have a good time. Movie theaters being built everywhere. Air travel. Now, air travel initially was to a large degree limited to wealthier people who could afford what would now seem like expensive airfares. But suppose your fairy godmother came to you and said, I have a prediction for you. These newfangled contraptions that can fly through the air from place to place, this is just the beginning of what will become an enormous global travel industry. You'll be able to climb on a plane in New York. You'll be able to have dinner in Los Angeles. You'll be able to fly over the oceans. Wow, what a great idea. And I can assure you, there will be tens of millions of new passengers flocking to this new industry. Great. Thank you, fairy godmother. What do you do next? Go out and invest in every airline you can find. Capitalize on this sure thing. What happened? Just about every major airline, there are far more than I pictured here. I couldn't stuff them all on the slide, went bankrupt. Did the industry not prosper? Well, the industry grew enormously, millions upon millions of passengers. But the benefit of that growth apparently went largely to the consumer of air travel in the form of lower and lower airfares, not the suppliers of air travel, the airline companies. This is a somewhat extreme example. We don't expect every industry to suffer like the airlines did. And in more recent years, they've been doing much better. But this is one possible reason why economic growth and stock market returns may not be closely linked. Now, the story can easily go the other way. Some industries or sectors could product labels we see on products in the supermarket. Was it the suppliers of the technology for barcodes, or was it the consumers of that technology? Walmart, Ross stores, Circuit Cities, and so on. Retailers who were able to streamline their inventory, figure out exactly what was selling in Tallahassee, Florida, rather than Boise, Idaho, and adjust their inventory as a result and enhance their profits. So this is a long-winded way of saying that there's not a strong link between innovation, growth, and stock market returns. And as a result, this is just one more reason why investors should diversify. It's never clear where the benefits of innovation will show up.
Very good. All right. So I had another question here, Wes, that's not on your presentation anyway, but it says, with all this bad news that we're hearing today, and this recession, it kind of goes back to the original question, this recession that's supposedly coming, why the heck are we seeing the market has gone up for the last, I think prior to today, it was 5 days in a row. Why would you see this given all this bad news?
This lesson has to be learned in almost every market cycle. Markets are forward looking. They are not backward looking. They are not even looking at current events. Let's go back and remind ourselves what it is we have when we own a share of stock. We have a claim on the future earnings and dividends of that company, not for next year, not for the next 2 years, not for the next 5 years. We have a claim in perpetuity. Perpetuity is a long time. So when investors are setting prices for securities, they're not setting prices on the expectation of just this year's cash flow or next year's cash flow. They're setting prices based on their expectation for cash flow, often to the indefinite future. The future varies. That's why prices are so volatile. Investors are competing to gather any scrap of news they can. But this cycle where we may have seen the bottom in the stock market, I don't know, but we've recovered about 30, 32%, I think it is, from the lows. As the news has, if anything, perhaps gotten even worse, certainly not much better. And many people are puzzled how this could be. But this is a textbook example of how markets work. They're anticipating a recovery long before the recovery even shows up. A great example would be the financial crisis in 2008 and 2009. Market bottomed on March 9th, 2009. And then it was up 10, 15% in a week or so. And then kept climbing through April, May, June. And many investors were scratching their heads. How can the stock market be going up when the news isn't just not getting better? It's getting worse. Unemployment kept rising. General Motors filed for bankruptcy. Chrysler filed for bankruptcy. Bank failures kept rising. How could the stock market go up? Because it was anticipating a recovery. Not in 2009, not even 2010 perhaps, but often in the years in the future, which is what occurred. Markets tend to be, again, the leading indicator of what the economy will do next, not a coincident indicator or a lagging indicator. So again, the stock market is not a perfect forecaster. I don't want anybody to assume that every time the stock market goes up, it's going to be a correct prediction of better times. More often than not, we're better off using the stock market as a predictor of future economic events than the other way around. So to see prices rise even sharply in the face of bad news, we can never explain exactly why stocks went up on any given day, and you can torture yourself trying to come up with explanations. But one helpful way to think about it is that suppose some negative sounding news shows up. What you really want to know is, what were investors in aggregate expecting? Maybe they were expecting the news to be even worse. And so it comes out and it's bad, but perhaps not as bad as some had feared. That in itself, in a strange way, becomes the good news. Now we don't want to fall into a trap trying to second guess everybody's estimate, but the market is a mechanism for aggregating all of these opinions.
Excellent. That aggregation is a very important concept. So someone else asked here about equity style drift among active managers. So you may not be aware of this, but SPIVA puts out their report, and one of the things they look at is the style drift of actively managed mutual funds. And it's somewhere in the ballpark of 40% of actively managed mutual funds drift from their stated style. Do you think there will be more style drift in a crisis like this?
I'll just hazard a guess that yes, there would typically be more style drift in a highly volatile environment. And it could partially be, I'm just guessing here, I don't really have any data to rest this supposition on, but money managers are in business to stay in business. They tend to be, to some degree, trend following. If technology stocks or whatever are doing really well, I think there's going to be a tendency to have a greater exposure to those technology stocks. And we can extend that idea to almost any kind of asset class description. If small companies are underperforming large companies, there may be a tendency to want to nudge the portfolio toward larger companies, even if the fund's mandate suggests they want to focus on small companies. We think this matters for investors because we think deciding what asset class your money belongs in, whether it's stocks or bonds or which types of stocks, that's your decision. You should hire a manager to implement that strategy that you've hired them to do. I don't think it makes sense to hire a small cap manager and have them go buy large company stocks. You should have a large cap manager do that.
That's why we like dimensional funds. You're very style pure as opposed to style drifting. All right. So thank you so much, Weston. I'm going to try to answer the next question. There's a question about why has our portfolio 100, you can listen in on this if you want, Weston.
Yep.
That's our globally diversified, small value tilted equity portfolio. Why has it done so poorly relative to a S&P 500 ETF, for example? And so I want to use a little tool that's available here in Zoom called a polling tool. And I'm going to pose some questions to the, how many of you? 136 of you. So get ready to put your thinking caps on. And I'm going to bring up a question here. So here is my first question to you. If you owned a portfolio that was 50% NASDAQ and 50% S&P 500, what would be your benchmark? And so get some interesting responses here, but what I like about this is we're capturing the wisdom of the crowd, if you will. And it seems like the overall winner is the 50-50 blend of a NASDAQ and S&P 500. So here we can see the results were 62 for the 50-50 blend, 15 for the S&P, and only 2 chose NASDAQ. Now that's kind of interesting. Why more on the S&P than the NASDAQ? My guess is it's a little more accepted general benchmark than the other. But the answer is this 50-50 blend. All right, so let's make this a little more complicated by taking 40% NASDAQ, 40% S&P, and let's add that small cap index, the Russell 2000, with 20%. Now, what do you think is your proper benchmark? All right, so I'm going to now share those results with everybody. So now we see that a 40% NASDAQ, 40% S&P, and 20% blend seems to be the crowd's opinion of the best benchmark, given the fact that that's how you've invested, right? So if you have 11 indexes, as you see in Portfolio 100, what is your right benchmark? The allocation that you have in that index? Or are you going to pick one of them? Russell 2000, emerging market value. Which one of these are you going to select to be your benchmark? And what we see here is that we have an overwhelming opinion that your best benchmark is the blended benchmark. And that, I think, is the main point I'd like to make about this. The wanting to beat a benchmark goes back to the active investing world. And we're not really in the business of trying to beat some particular benchmark. And instead, we're trying to assemble a group of benchmarks, a group of indexes from all over the world, provide that diversification that Weston so eloquently presented to you, and also look at the academic research on the dimensions of returns and small and value and now these profitability factors, and really try to build portfolios that have the highest expected return over the very long term. Now, expected is a loaded word, and it really refers to the fact that you're not going to get it. It's expected. And really, if you think about future returns, they're like bell-shaped curves. And all the expected really means is it's the center of a future probability distribution of returns. But I do happen to have a historical chart that looks at the blend of these 11 indexes against one of those indexes. And it can give you and remind you of this difficulty of trying to be in a position where one investment does better than another. And so we're in the 10-year range maybe now of where we have not seen a premium, maybe even 15 years. But what are the probabilities of that based on some 50 years of data? Well, in 10-year periods, roughly 1 in 3 10-year periods, you would have been better off here in that S&P 500 versus that blend. By the way, it's on the other side, it's 68% advantage for owning that. But if you end up in one of those periods, that should be expected and it should be accepted because these are random outcomes. The active investment world wants an explanation for these results, when in fact there isn't one. It's market randomness, and market randomness has to do with the fact that what Weston was stating, that the market's always setting a fair price. And then from that fair price, it resets everything so you're starting from a more even point of view. But look at this, even in 20-year periods, as Weston described, the 20-year period where you have been better off in bonds than in stocks, here's a roughly 10% of the time where you would still be better off owning that S&P 500. So 1 in 10 of those periods, you would be better off in the other one. So I think the best thing is not to torture ourselves over our good or our bad luck, and mostly with our bad luck, we want to torture ourselves in the fact that in 1 year period, we didn't win, we didn't beat something. This is not about winning or beating. It's really about understanding the long-term research that says when we look at the long-term averages, we see that there has been an advantage to tilt towards these factors of size, value, and profitability. And in designing diversified portfolios, we want to look at this long-term data and target it as we put together these portfolios. So that's my answer to that. And I think at this point, we've answered a lot of questions, and hopefully we've helped you out. And Weston, I want to especially thank you for taking time on your farm back there in New Hampshire and joining us this morning. And I also want to apologize a little bit for our audio quality, but this is where we are today. This is really the best we can do. But I think it actually is fabulous that we can get someone like Weston to do this live talk with you and share his very valuable opinions with all of you. So with that, once again, I thank you for joining us, and we hope to see you on our next webcast if we can put together another one. Weston, you got any closing comments there? Or?
Just want to say I appreciate the opportunity to discuss these items with you people. And Mark, if you ever want to call me back, I'm at your beck and call here in the wilds of New Hampshire. Call anytime.
Excellent. All right. Everybody have a great day. Bye-bye.
Thank you.